If you're buying a home in 2026, there's a strategy that can lower your payment by several $100s a month. It's completely legal, it's widely used, and most buyers still don't fully understand it. But here's the twist. As good as this strategy sounds at first, there's another one that doesn't look nearly as exciting, yet over time, it actually saves you even more money. Now, this video isn't about timing the market, and it's not about guessing where rates are about to go. This is about how smart home buyers structure offers, and why the best financial move often doesn't feel like the best one at first. Let's dive into it. This is chapter 1, where real negotiations happen. Most buyers think that negotiations end with the price. You can either offer more, you can offer less, or you can meet in the middle. But your financial life doesn't feel like a purchase price. It feels like a monthly payment. And in 2026, the smartest offers aren't going to be focused on lowering the price. They're going to be focused on lowering that payment. And that leads us to chapter 2. This is a strategy that everyone loves. So let's talk about it. It's called the 3-2-1 temporary rate buydown. And here's how it works. Your interest rate is reduced 3% in year 1, 2% in year 2, and you guessed it, 1% in year 3. And then it resets. So let's use real numbers, and to keep it simple and easy to understand, we're going to use the same example throughout this video. So let's talk about a loan amount of $400,000 at 6.5% interest. That will give you a normal payment, a principal of interest of $2,528. Of course, that's just principal interest. We're not talking about taxes and insurance here. All right, so in year 1, if you were at 6.5% and you went down 3%, you'll be at 3.5%. That comes to $1,796 per month. That is a savings of $732 every month, or nearly $8,800 in year 1 alone. And this is why people love this strategy. In year 2, you drop from 6.5% to 4.5%, and the payment rises from last year to about $2,027 per month. That's still saving you about $500 a month, or roughly $6,000 that year. Year 3, you're at 5.5%. Payment increases again to about $2,271 per month. That's still saving you about $250 a month, or roughly $3,000 that year. So the total 3-2-1 savings over the first 3 years is about $17,900 saved. That's real money, and it all happens upfront. All right, chapter 3, here's the catch that almost no one talks about, and it's also the part that rarely gets explained. After year 3, the rate resets back to 6.5%. The payment returns to $2,528. And from that point forward, there's no more savings. So even if you look at this over a 10-year period, you still only saved about $17,900 total. All of the benefit is front-loaded. That doesn't make this a bad strategy. It just makes this a short-term win. All right, so that takes us to chapter 4, the strategy that looks worse, but it isn't. Before we unpack the best plan that rarely gets explained, I'm going to ask you to please subscribe or follow this feed. That would make this guy happy, and it may also help someone else who would have otherwise not seen this video or heard this podcast. And your subscription or follow could very well be what helps this person save thousands of dollars. So, consider it paying it forward. All right, let's talk about the option that doesn't feel nearly as exciting, but is the best one. That's the permanent rate buydown. It's the same loan, the same $400,000, but instead of lowering the rate temporarily, you are permanently reducing the rate from 6.5% to 5.99%, or something similar. All right, let's use that example. At 6.5%, the payment comes to $2,528. At 5.99%, that payment drops to $2,395. Now, that's a savings of about $133 per month. That's not dramatic. There's no fireworks there. And this is usually where people lose interest, which leads us to chapter 5, why time changes everything. Mortgages are front-loaded with interest. So lower rates don't just help later, they help you earlier. And when most of your payment is interest, over the first 10 years at 6.5%, you'll pay about $242,497 in interest. At 5.99%, that's $222,129. That's over $20,000 in saved interest, which means the permanent buydown quietly beats the 3-2-1 strategy, even though it feels less dramatic. And that leads us to chapter 6, how a permanent buydown actually works. So, how does a permanent buydown actually work, you might ask? It's done by paying discount points at closing. 1 point typically costs around 1% of your loan amount. And on average, 1 point lowers your rate by about 0.25%. That's the rule of thumb. It's not a law, it's just a rule of thumb. And that's the important part. That number isn't fixed. Those rates change daily. At the time of this recording, my lender partner told me that 1 point can sometimes buy a rate down by 0.5% or even 0.75%. Then that's depending on your specific loan type and scenario. It's the same tool, just different market conditions and different buyer situations. So make sure you ask your lender what the rate buy down is for your particular case and see if you can get that bought down by the seller. Now that leads us to chapter 7, the real comparison. So here's an honest side-by-side comparison doing the 3-2-1 buy down versus the permanent rate buy down. So the 3-2-1 is about $17,900 saved, all savings happening in 3 years, and then the savings stop. A permanent buy down is about $20,400 saved in 10 years. The savings continue every single month, lower interest, and a lower balance over time. The temporary option feels better upfront, but the permanent option is better if you're thinking long term. And that takes us to chapter 8, why offer structure is everything. Here's the final piece. Neither of these strategies work if you pay for them. They work when the cost is covered by a seller credit, which has to be negotiated before the offer is accepted. And this is why smart buyers don't just ask, what's the price? They'll ask, how do we structure this offer so it costs me less money every month? In 2026, the best financial move doesn't always look like the best one at first. Sometimes the strategy just feels quieter, but it can save you more money over time. And the smartest buyers are the ones who understand the difference. And if you like to buy or sell in Southeast Florida and want to strategize how this can help your listing or offer, well, reach out to me. I'm Cusimano. I'm the team lead at the Homes by Cusi team, and I'd love to plan it out for you.